Aditya, with your permission, we now invite another of our guests, Paresh Sukthankar, Deputy Managing Director of HDFC Bank, joins in. Good morning, Mr. Sukthankar. Thank you very much for joining in what is a very special discussion for us when we invite a guest editor. Additionally, Aditya Narayan, though he's a city equity strategist, has a special love for financial sector. It is his own sector. Well, for starters, what do you think, how do you look at the banking space itself? We were discussing with him the theme of asset quality. What's your sense? You don't know the meaning of asset quality problems in your bank, but as an observer of the sector, do you get the feeling that we're going to see some more quarters of pain, one more quarter of pain?
Well, if you look at the pace of NPL formation, or for instance the pace of increase in restructured loans, I think you've already seen that pace ebbing a little in the last couple of quarters. But if you're looking at percentage NPLs coming off, or maybe even stabilizing, that I think will take a little longer, whether it's a quarter or two. I think it's certainly going to be something in that range. And frankly, that shouldn't be surprising, because what you've seen so far is that although we are off the 4.3, 4.5% lows in the economy, we are still firmly in the sub-5 range. And to that extent, therefore, the relief that you've seen right now in the pace of NPL formation is probably more to do with the positive sentiment and the markets doing well, which perhaps afford the opportunity for stressed borrowers to either monetize assets or to deleverage. The cash flows and profitability improving, and that helping reduce pressure on asset quality, I think will take some more time. Of course, this is adjusting for any sales of NPLs, but actual formed, organically formed NPLs on the books coming off, I think will take a couple of quarters.
And loan growth, do you see that picking up sooner than asset quality stabilization?
Well, again, loan growth, if you notice, Lata, in the last few months, it's been languishing actually at levels which are around 13%, which has actually been even a little lower than what it was a while back, when arguably the economy was going even slower. We've been a great believer in this multiplier of GDP to arrive at what is an expected or reasonable loan growth. So if we expect that the economy does about 5.3, 5.5% this year, if that's the expectation, then that 13% does need to go somewhere closer to a 15%. Are we seeing a lot of that happening immediately? Probably not. You have a few segments here or there, or an odd anecdotal sort of evidence which is coming through. But across the board pickup will happen again. Will it be a little faster than the asset quality improvements? Probably more or less will coincide with that. Okay. Because again, the same relief which comes in terms of the markets allowing corporates to deleverage also creates debt raising capacity, and therefore will enable corporates who are going in for the next capex cycle to borrow as well. But right now, I think you're in that phase when things have stopped getting worse. The sentiment is positive. People have probably started talking about things getting better. But on the ground, naturally, this is going to be a gradual phenomenon.
Okay. Aditya?
Yeah, Paresh, hi. Paresh, one of the things that is probably also creating the slightly slower loan growth is the fact that risk appetite from the system has pulled back quite substantially and very understandably. On the way up, or as things tend to pick up, do you think that in some senses that could be a little bit of a retardant in terms of how much money is actually put out, or how much loan growth can accelerate, even if the broader environment is looking a little better?
I think you make a fair point, because as things start improving, if the system as a whole between NPLs and restructured loans is sitting on roughly double-digit stressed assets, then I guess most banks would want to focus on getting their recoveries going or improving asset quality in the upcycle. That doesn't mean that there isn't going to be a focus on putting out loans, but I think banks are pretty quick to react to changes in the economy and the mood. So if there are bankable opportunities even today, and even on the way up, I think banks will be more than happy to capitalize on those. The capital positions of banks again is the other factor which in some ways influences the risk appetite of banks, and again you have a mixed bag there. But on the whole, I think if you start seeing the economy picking up, if you do see the capex cycle, coming back again, I think you should see loan growth picking up, and I don't think you'll find banks wanting in terms of financing bankable projects.
Okay.
Maybe just an add-on on that, and it's relevant to your business because you're also now looking on a little bit more aggressively at the entire projects financing and the longer terms space. Now, one of the issues with the asset quality cycle is that it's been concentrated in that space. So do you think this is a space that will also get enough money back, if the environment is actually better? Because it's one thing having a generic problem on the asset book. It's another thing, the problem being very specific in a space. And if one were to go back to the retail credit cycle that actually happened, where you were a big beneficiary of, not getting hurt and then actually gaining market share as others stayed out of it on the way back. Do you think a similar thing could happen out here? And, from your bank's perspective, could it actually be a big opportunity that you have both the appetite, you don't have the issues, and there is demand that's actually surging in the market?
Well, I think it certainly helps us not to have the hangover of a very high level of NPLs. Right now, even as of June, we were at 1.1%, which is not just low in relation to the system, but even lower than what our historical average has been. If you look at our 18-year average, it was probably somewhere between 1.3, 1.4. So in some ways, we've probably been through this cycle and have virtually avoided the peaks that one would normally associate in NPLs with a downturn in the economy. But to your points, I think on the retail side, part of the reason why you've seen a much more stable asset quality, perhaps in the system as a whole, and certainly we've benefited from that, is the fact that over the last few years, after the 2008-9 learnings, I think the level of aggression by and large has been a little muted. And of course, the credit bureaus, the learnings that banks have had in terms of fraud controls and so on have also helped. But again, I think complacency in any sort of lending is a terrible sin to have. So to believe that just because we have not seen high NPLs in a lot of the retail products in the last couple of years, to believe that means that retail lending is just intrinsically lower risk. You just have to go back a few years to learn that, to remember that was not necessarily the case. So I think there are going to be good opportunities and bankable opportunities both on the retail side as well as on the wholesale side, including the project finance space. And again, there, if you were to split this between the manufacturing capex and the infrastructure capex, a lot of the issues have been specific to individual projects, individual borrowers. And some of these, of course, have also been slightly sectoral. But I think in our experience, where we have stuck to projects which we believe that the diligence was done properly and the sponsors were bankable, you can't run away from the inherent risks, but they can certainly be much more bankable than what we've seen ultimately unfolding in the last couple of years.
Mr. Sukthankar, I just had one question. This time around, your profit growth was very strong at 21%, but it is, the lowest we've seen in many quarters. So in that sense, we've been a bit spoiled as far as HDFC Bank's numbers are concerned. Have the credit costs gone up this time around, especially in, some of the sectors like SME, agri, commercial vehicles, etc.?
Well, so we did see, let me break that into 2 points. One is, obviously the profit growth is a function of both the revenue growth and what happens in terms of expenses and credit costs. The swing, if any, in this quarter on revenues was really more the fact that last year, in the corresponding quarter, we had bond gains which were upwards of 200 odd crores, and this year they were 25 crores. So if you look at the core revenues, which is net interest income or the other lines, those continue to grow at a reasonable pace, of course, in the within the context of how the economy is doing. Our operating costs again were in check, so our cost to income ratio improved a little. But on credit costs, if you look at it year on year, we had about a 4 basis point increase in gross NPLs, which I'm glad that it sort of gets noticed, because it means that you sort of probably have a reputation of having had not too much of movement. But yes, the point that I had sort of made when I discussed the earnings as well was that the increase in NPLs of these few basis points was not from one or a specific sector or a specific segment. We saw a little bit of it coming from some agri, some SME, and some retail, which includes the commercial vehicle and construction equipment businesses. And I think in some respect that is really what the portfolio is all about, which is that our portfolio is so highly diversified, first of all between wholesale and retail, and then within retail across 6 or 7 products, and again within wholesale across 20 odd industries, a lot of it working capital, some of it of course medium-term loans and project finance, that the concentration risks typically are much lower. And so even when we do have some slippages, they tend to be a little more dispersed rather than from a particular customer or particular segment.
Okay. Sukthankar, we are running out of time, so I want to pack in as much as I can. Will you be issuing any of the infra bonds? Will that be will we see something this year?
Yeah, I think it's certainly something which looks very interesting. Obviously, we have to go through the the approval process and so on, but I think it's certainly a very good idea to raise.
But how much do you have in terms of exposure to affordable housing and to infra? To the maximum, how can you? Because historically, you can take 16% in the first year. How much headroom do you have?
Well, what we look to really raise for is first, of course, the increase in exposure, because the runoffs, which are allowed in that staggered manner, are in respect of the existing exposure coming off, and therefore you're being able to finance it. But most of what we originate in terms of home loans would come under the and most of what we take on our balance sheet are essentially the PSL home loans, which squarely fall within that affordable housing piece. And again, while our base may not be very large, we have been increasing our exposures on the infra side as well, and we plan to do some of that this year. So even if we have to raise a few thousand crores, we will have the appetite to put out those assets as well.
Aditya, you think that these bonds with no SLR, CRR, PSL problems could create a medium-term bond market and thereby give banks, smarter banks, private sector banks, an edge? First year it is 7 years, but in the next 5 years you're going to get along the curve.
Yeah, I think it clearly opens up more funding and cheaper funding and a new market to access. I think the pace at which it develops is something that one has to watch. But I think clearly it's a very positive regulatory development. I think in some senses it also eases some of the regulatory burdens that the system has taken, and it kind of directs it to a particular area of lending without it being hard directed. So I think it is a positive development. I think for most banks, it stretches their maturity profile. It should balance it out a little bit between assets and liabilities, and that can only be good. I think the extent to which it develops, the pricing, the liquidity that is there in the aftermarket, I think that will determine how big and how effective it actually becomes. But I definitely think it's a step in the right direction.
I have to build up to that inevitable question to Mr. Sukthankar. Mr. Sukthankar, when will HDFC really think in terms of merger? Will you be watching to see how RBI tackles IDFC's historical loan book and how much forbearance it gives them? Will you all make the move after that? There must have been some discussion.
Well, I think, Lata, we have tried to answer this both from the HDFC side and my side, our side as well. But let me try it once again with feeling. The fact that this does, I guess, potentially address a huge hurdle in the merger in the form of the reserves, I think that's a reality. Obviously, it's also a function of, as we were just discussing, the size of the market in terms of how much of these bonds can be raised, and therefore that's the amount which will provide relief in terms of reserve requirements. And again, the circular clearly sort of today talks about incremental growth. What it does to the historical book, is still an open question. And you may be right, some indications may well come through when, if there is clarity on what happens on the IDFC side. But honestly, all of that is still, a fair amount down the road. I mean, at this point of time, we will want to do a lot more homework on our side, understand both from in terms of some clarifications within the circular, do our own number crunching. So it's not just any one particular milestone that we are looking at in the market or from the regulator. It's certainly something that will have to be looked at. That's not yet happened in any in any seriousness at all. So unfortunately, I'm not in a position to give you a date because there is nearly no roadmap or a path. But certainly, it's something which is worth looking at because the development, the regulatory changes do probably throw open some opportunities.
You want to ask, add on to it in any way?
No, you're getting it from the horse's mouth.
No, finally, can you all set up a payments bank?
Sorry, I didn't get that.
No, can you all set up a payments bank or liaise with a telecom company in some fashion? Or do you see that as a competitor for you?
No, honestly, I think, just given the size of the unbanked market, I think, there's not just room but probably need for, multiple models, and certainly payment banks will meet that, some portion of that market in any case. But, and there may be an odd segment that you might land up competing in, but really there are also equally great opportunities to collaborate. Because remember, a payment bank will provide the the deposit and the remittance product, but customers of payment banks will also look for for borrowing. And to that extent, there will be opportunities as you bring more and more customers from the unbanked into the banked, and if some of these customers are with payment banks, there will be opportunities for payment banks and full service banks like us to collaborate and meet the customers' needs.
All right, Mr. Suktankar, we have gone on for a goodish bit. Thank you very much for obliging us and joining us on What's a Special Day for Us.